In the fast-paced world of finance, opportunities for profit often arise from market inefficiencies. Arbitrage trading is one such strategy that exploits price differences of an asset across different markets or exchanges. This strategy involves simultaneously buying and selling an asset to capitalize on the price discrepancy, thereby locking in a risk-free profit. Arbitrageurs act as intermediaries, bringing markets closer to equilibrium by exploiting these price differences. Arbitrage trading is a time-sensitive endeavor, as price discrepancies are often short-lived. Traders need to act swiftly and decisively to execute trades and secure profits before the opportunity disappears. The rise of cryptocurrency markets, with their inherent volatility and decentralized nature, has opened up new avenues for arbitrageurs. These markets are often characterized by significant price differences across exchanges, creating ample opportunities for savvy traders. Cryptocurrency markets are known for their extreme price fluctuations. This volatility, while daunting for some investors, presents a fertile ground for arbitrageurs. The decentralized nature of cryptocurrencies means they are traded on numerous exchanges around the world. Each exchange operates independently, with its own order books and trading volumes. This fragmentation leads to price disparities, as supply and demand dynamics vary across exchanges. Furthermore, the nascent stage of the cryptocurrency market contributes to these price discrepancies. Regulatory uncertainty, technological advancements, and market sentiment can all impact prices differently on different exchanges. This creates a dynamic environment where arbitrage opportunities emerge frequently. However, it is important to note that crypto arbitrage is not without risks. Traders need to be aware of the challenges and pitfalls associated with this strategy before diving in. Spatial arbitrage, also known as geographic arbitrage, is one of the most common types of arbitrage in cryptocurrency markets. This strategy involves taking advantage of price differences for the same cryptocurrency on different exchanges. For instance, Bitcoin might be trading at a lower price on exchange A compared to exchange B. An arbitrageur would purchase Bitcoin on exchange A and simultaneously sell it on exchange B, pocketing the difference as profit. To execute spatial arbitrage successfully, traders need to have accounts on multiple exchanges and sufficient funds to cover transaction fees. Timing is crucial, as price differences can evaporate quickly due to market movements or other arbitrageurs exploiting the same opportunity. Additionally, traders need to factor in withdrawal and deposit fees, as well as the time it takes to transfer funds between exchanges. Triangular arbitrage exploits price discrepancies between three different currencies on the same exchange. This strategy involves converting one currency into another, then into a third, and finally back to the original currency, aiming to profit from the price differences along the way. For example, an arbitrageur might identify a price discrepancy between Bitcoin, Ethereum, and Tether on a particular exchange. The trader would start with Bitcoin, convert it to Ethereum, then to Tether, and finally back to Bitcoin, capitalizing on any price differences between the currency pairs. Triangular arbitrage requires a keen eye for identifying price discrepancies and the ability to execute trades quickly and efficiently. Traders need to consider trading fees and slippage, which can eat into profits if not managed carefully. Section 5. Statistical Arbitrage, Unveiling Hidden Opportunities with Data. Statistical arbitrage employs statistical models and algorithms to identify and exploit pricing inefficiencies in financial markets. This strategy often involves analyzing vast amounts of historical data to identify patterns and correlations that can be used to predict future price movements. In the context of cryptocurrency, statistical arbitrageurs might use machine learning algorithms to analyze market data, identify mispricings, and execute trades automatically. This type of arbitrage requires a strong understanding of statistics, programming, and financial markets. Traders need to develop robust models that can adapt to changing market conditions and manage the risks associated with automated trading. While potentially lucrative, statistical arbitrage is a complex and sophisticated strategy that is not suitable for beginners. Section 6. The Perils of Arbitrage, Risks and Challenges. While arbitrage trading presents enticing opportunities for profit, it is not without its risks. Market volatility, execution risks, and competition from other arbitrageurs are just a few of the challenges traders face. Market volatility can cause price discrepancies to disappear quickly, potentially leading to losses, if trades are not executed swiftly. Execution risks arise from the possibility of errors in trade execution, such as placing orders at the wrong price, or experiencing technical difficulties with trading platforms. Competition from other arbitrageurs can also erode profits, as price discrepancies are often exploited by multiple traders simultaneously, driving prices closer to equilibrium. Section 7. Getting started. Practical steps for aspiring arbitrageurs. For those interested in exploring the world of crypto arbitrage, several practical steps can be taken to get started. First, it is crucial to gain a thorough understanding of the cryptocurrency market and the different types of arbitrage strategies. Next, aspiring arbitrageurs should choose reputable cryptocurrency exchanges with high liquidity and low fees. It is essential to start with small amounts of capital and gradually increase investment as experience grows. Implementing robust risk management strategies, such as setting stop-loss orders and diversifying across multiple exchanges, is crucial to mitigate potential losses. Section 8. Mastering the art of crypto arbitrage. Tools and resources. Several tools and resources can aid traders in their crypto arbitrage endeavors. Cryptocurrency arbitrage bots automate the process of identifying and executing arbitrage opportunities, allowing traders to capitalize on price discrepancies more efficiently. These bots monitor prices across multiple exchanges and execute trades automatically based on preset parameters. In addition to bots, various websites and platforms provide real-time market data, arbitrage opportunity scanners, and educational resources. Traders can leverage these tools to stay informed about market conditions, identify potential arbitrage opportunities, and enhance their trading strategies. However, it is crucial to thoroughly research and understand the risks associated with using any third-party tools or services. Section 9. Unlock your financial freedom. Join Money Mastery today. Are you ready to take control of your financial future and explore the exciting world of cryptocurrency arbitrage? Look no further than Money Mastery, your ultimate guide to navigating the complexities of the crypto market. Our comprehensive resources, expert insights, and supportive community will empower you to make informed decisions and maximize your earning potential. Join Money Mastery today and unlock a world of financial opportunities. Our team of experienced traders and analysts will provide you with the knowledge, tools, and guidance you need to succeed in the crypto market. Don't miss out on this chance to transform your financial life. Join Money Mastery and start your journey towards financial freedom.